The US government is over $30 trillion in debt, and the UK government is over £2 trillion in debt. So where is all this money coming from? The answer is borrowing, but we have a special name for this in economics. The name's bonds. Treasury Bond. So in this video, I'm going to explain what a bond is, what we mean when we say bond yield, and also let you in a little secret that allows the government to borrow more money than they should. So a bond is effectively an IOU. What a bond does is lay out the term of the bond, for example 10 years, the amount that's going to be borrowed, for example £100, and an interest payment to be paid on that borrowing, in this case 10%. We also call this the coupon yield. That means every year that you hold this bond, you're going to be paid a £10 coupon. Now do note that bonds don't compound like savings do. So for example, you don't get paid 10% on the £100 with the addition of the coupon because you get paid the coupon every year. So it's not like after the first year, you'll be paid 10% on £110. You are paid a consistent coupon every year of a set amount, which is expressed in the bond. Now there are different types of bonds, and the best way to think about this is if you were going to lend money to someone in a pub. A government bond is the most secure type of bond. For example, in the US we have treasuries, and in the UK we have gilts. They're called gilts because traditionally they had a golden edge or a gilted edge. Now the reason why these are the top tier of bonds is because they're considered the safest, and this is because of the history of them. Imagine it like the old guy that's in the pub. You lend him money and you feel safe to lend him money because he's borrowed money from everyone else in the pub and has always paid it back on time. This is, for example, like the US, who have never defaulted or who have never not paid back a bond. Of course, all government bonds are not the same. Some governments do not have the history of repaying bonds on time, and they may also be suffering from an unstable economy. Bonds that are issued by these types of countries tend not to be viewed as safe as, for example, bonds issued by the United States. On the flip side, we also have corporate bonds, and these are bonds which are issued by a corporation rather than by a government. And with corporate bonds, we have a similar level of tiering whereby some of them are safer than others. A bond issued by a company like Apple is considered very safe. In fact, some people may consider it as safe as a US Treasury. That is because Apple has a proven track record of paying back their bonds. They also have a very stable business model, despite what's been happening recently. And they also have massive amounts of cash on hand. In fact, Apple have more cash on hand than some banks. This would be the equivalent of the guy in the pub who arrives in a Ferrari, he's got a load of cash in his wallet. Why he'll be showing you all the cash in the wallet, I don't know. But you know he's going to pay you back. Why? Because his accounts look pretty good and he looks like he's got a good business going on there. Next up, there'd be the corporate bonds issued by companies such as Credit Suisse. This would be the equivalent to the guy in the bar who used to be in a high-paying job but has recently been struggling a little bit, and he's looking increasingly the worse for wear. Credit Suisse, for example, I did a whole nother video on this, have been struggling with their finances and to stay afloat, so investors may see their bonds as more risky. Finally, we have corporate bonds that are issued by small or relatively unknown businesses. The problem with these is these businesses do not have a proven track record of performing and delivering on their bonds, so this leads to more investor risk, and therefore they're going to want a higher return. So you can really see here the diversity in the types of bonds that are offered in the financial market. Let's go back to this bond that we said here. So the most common type of bond that we see is a 10-year Treasury bond, which is issued by the government. Do note that bonds vary in the length of time it takes before they mature. What we mean by mature is how long it takes before this bond will pay out all its coupon payments and then pay you back your initial investment. They can range from 1 month all the way up to 10 years or more. When this bond is issued, we know that you've lent the government £100 and they are due to pay you back £10 every year for 10 years because that's the 10% coupon yield. So in effect, this bond is worth £200 in 10 years. Now, no, it isn't really like this because we know that these £10 coupons are going to be paid back every individual year, and at the maturity of the bond, you will then get paid back your £100, but we can kind of think of it this way. So this bond has a value of £200 if you hold it to maturity. But also note the effects of inflation. So if inflation is high, then that's going to degrade the value of this coupon payment. For example, if inflation is at 3%, in a very crude way, we could suggest that actually you're going to get a 7% return. So this makes a lot of sense. So we have our bond, it gives us a set amount of coupons per year, and that then pays for our return. So here, for example, a £100 bond will give us £100 in return because we have a 10% coupon yield, which means we're getting paid coupons of 10%. The current yield is therefore 10%. However, yield is directly related to the price you pay for the bond. And we know that bonds can be traded freely on the market. Now, one quick thing to note, we said that this bond here would be worth £200. However, after 1 year, it will only be worth £190. And that's because we would have cashed in one of these coupon payments, which means we've only got 9 coupon payments left of £90. So the return on the bond in total will be £190 for whoever cashes it in. So if you sold that bond on, the price would reflect the missing coupon payments. So let's say you own this 10-year bond. The market has changed and changed the price on this bond. So this bond is now trading for £120. It's still a 10-year bond, and we know that the coupon yield remains the same because that is set when the bond is issued based on current market interest rates. Your return, and again I've put nominal here, so we're assuming there is no inflation in the market. Now your return is going to be lower though, because actually you would make your £100 back, but you would only in addition to that make £80. That would mean your current yield, so the yield adjusted for the price the bond is currently trading at, would be 8.33%. So same bond now, and today you look at the market and actually the price of that bond has gone down. That bond is now only worth £80. Same thing applies, so we know that the coupon yield is always 10%. You've now only paid £80 for this bond, which means your return is effectively going to be £120. This means the current yield adjusted for the market price on this bond would be 12.5%. Now this explains why, when we see fluctuations in the price of bonds, we see fluctuations in the yield. But why do we see this? What explains this phenomenon? Well, it's supply and demand. The main thing that adjusts the price of bonds is going to be the current rate of interest. And that's because, as Warren Buffett said, interest rates act like gravity. If you think the central bank are going to cut interest rates, but you want to invest in bonds, it may be a good idea for you to buy the bond at a slightly higher price. If the rate was 10%, but you think they're going to lower it to say 6%, well then if you buy at this price, £120, you still get a yield of 8.33%, which would be higher than any newly issued bond at the lower interest rates. Similarly, if you thought the central bank were going to put interest rates up, you would likely not buy this bond here, because if the current interest rate is 10%, you may think they're going to put it up to 14%, so you won't want to pay here. Instead, the market will adjust itself so you pay £80 for the bond, and therefore you get a higher rate of return of 12.5%. That's not the 14% that the interest rate could be put up to, or what the proposed future market yield of bonds will be. However, you're going to be happier of this because it's a risk at the end of the day. They may not put up those interest rates. So here actually you get a pretty good deal. As you would have seen in my video on the mayhem of the UK economy and how the market nearly crashed, we've seen very high levels of government bond yield. So what is causing that? Why are yields very high? It's because prices have been going down. As people have been selling their bond, that effectively means that the yield goes up because there's an inverse relationship between them. There's also a very clever trick that governments can do here in order to borrow more money. If we go back to where we've begun with the 10-year bond at 10%, what the government does is they never actually have to pay off the initial £100 that they borrowed. Instead, what they have to do is just meet the 10% payments every year in order to stay financially stable. And when the bond matures at 10 years, what the government do is they don't pay back the initial £100. Instead, they just borrow it from someone else on a new bond. And this answers the initial question of the video, which is how on earth are the government able to borrow so much money? So I hope you found that video useful. I also just wanted to take the opportunity to say thank you so much for the positive reaction I've had to these videos. I set up the channel mainly because I wanted to have people talking about and learning about economics. I think it is an unnecessarily complicated subject. I actually think economics is quite intuitive. It's just kind of taught quite badly. But also thank you so much for asking your questions in the comments, and also for people answering those questions, because obviously I can't know everything and people have been contributing and sharing that knowledge. And yeah, have a really great weekend, and I'll see you all in the next video.